In this next section on smart money M&W formations, we're going to take a look at two popular but often misunderstood structures which are used by smart money to induce traders into the market, shake out traders that are in line with the smart money trend, and also trap volume for future accumulation. And this again is the M and also the W formations. Okay, so M&W formations are manipulation structures used by smart money to trap volume and shake out retail traders. These formations are often seen at the end of three phases of rise or fall, both intraday and weekly. And as we've seen in some of the examples that we've looked at throughout this course, they generally appear after three rises to the up or the downside during the intraday trend. And also we see them in level 3 accumulation after 3 levels of rise during the weekly trend. Now, these formations at their core are stop hunts, and they are created to accumulate retail orders before a trend reversal takes place. The formations can be used to identify the start and also the end of a phase. So again, if you're ever confused as to what part of the smart money intraday or weekly trend you're in, if you look back and you look for the M or the W formation, this will give you a great indication as to whether you are at the start or at the end of a phase or a trend. Okay, so if you see the M formation and you count backwards and you see 3 levels of rise or fall, then you know that the market is highly likely to turn or continue the trend, but it will allow you to prepare for level 3 accumulation and the trading of both sides of the market. So by looking at and identifying the M&W formation, it will always give you a reference point as to where you are within the trend. So on FX charts, they're referred to and taught as double tops and double bottoms, and I'm sure those are two terms that you're very familiar with. If you've been around the technical world for some time, double tops and double bottoms are probably the most referenced structures other than AB equals CD patterns in all of technical analysis. Now, most retail traders are taught how to trade the effect of this manipulation process without any understanding of the cause or purpose of their formations. Okay, so again, most retail traders will be taught how to identify the double top and the double bottoms. There will be a variety of techniques in terms of how to trade them, but in terms of the real cause behind the structures and the real process which is taking place, which at the core again is a stop hunter manipulation, is generally not known by the retail trading communities. Now, on the charts, these manipulation structures will most often appear as a failed or rejected retest of higher or lower prices. Okay, so as you will see, the M&W formations both have two variations. The most common you will see is this rejected retest of a lower or higher price, and we're going to take a look at an example of these structures. In this first example, we're looking at the dollar yen on the 60-minute chart, and after 3 levels of rise, we've entered into level 3 accumulation, where we have a M formation stretched over the course of 3 days. Now, in terms of what is widely taught to retail traders, they're simply told that this structure is called a double top, and then there is a variety of techniques on how to trade the structure. Now, the real cause behind the formation is the stop hunt and absorption of retail orders. So in this example, we're going to take a look at the process that takes place in both the M and then the W formation. So on Thursday, we have phase 3, and we have the market enter into a prior manipulation level, and we see the penetration of the zone. Now, what tends to happen is, because retail traders 95% of the time on the wrong side of the market. We generally get most retail traders buying into the market or selling into the market when smart money are going to liquidate the majority of their position. So as smart money move price action into this prior level of manipulation and they see an influx of buying from retail traders, they sell into this buying pressure and we see the market begin to move to the downside. So if you can imagine, as a retail trader, you've bought at the top of the trend here and you will place your stop loss in and around the mid to the end of the prior rally, you become instantly trapped. Okay, so you're going to have many traders who bought into the market here. You also have your breakout traders who would also bought on the breaking of the prior manipulation zone, and this creates a deep pool of liquidity for smart money to execute and liquidate the majority of their position. Now again, those traders who are trapped here and have their stop loss orders within the mid or the end of the rally, as the market comes down, simply get stopped out. Okay, now what also happens is, as smart money begin to liquidate their position and we see this move to the downside, we get an influx of retail sellers. Okay, so you're always going to have opposing views in the retail world, just like you do in the institutional world. And as we see the market come down through liquidation, we begin to get sellers coming to the market. Now, these retail sellers, again, will place their stops generally above the last swing high or within the mid of the range. So smart money liquidating their position and selling into buy orders will see a build up of stop losses from the sellers, and they will move the market back up and trigger the stops of the sellers that entered the market. Okay, so the sellers that came into the market on the liquidation of the position will place their stop losses generally above the swing high or within the mid of the range, and as smart money see the build up of these retail orders, again will move the market up, and this will allow them to sell into the buying pressure of the orders and then begin the trend to the downside. Now, the traders who sold at the bottom of the liquidation period will also become trapped. So you have the buy orders of the retail traders who bought into the market on the break of the manipulation zone. You also have the buy orders of the retail traders that sold during the liquidation period. And smart money will move prices into the buyer stops, sell into that pressure, and then move the market down. So the M formation in a nutshell is the manipulation and the absorption of buy orders. That is 9 times out of 10 the intention behind the M formation. The retail traders that are caught in the middle, so these retail sellers, they are generally in line with the new trend that is about to unfold. So those traders who sold into the liquidation zone are generally in line with the market maker trend. And if we move the market on, we can see that the market ultimately moved down. So this move back up, or the second leg of the M and also the W formation is where the shakeout of those retail traders who are in line with the market maker's trend occurs. Okay, so again, the M formation in a nutshell is simply the absorption of as many buy orders as possible, and also the shaking out of retail traders who are in line with the market maker trend. In this next example on the euro dollar and the 60-minute chart, we're looking at the W formation, and there is no difference in terms of the process that takes place between the M and the W formation. The M formation is primarily for the accumulation of buy orders that smart money can sell into to move the market into a downtrend, and the W formation is the opposite, where it's the manipulation of sell orders, so smart money can buy into these orders and move the market into an up or a bull trend. So in this example, we've had 3 levels of fall, and then we have the market move into level 3 accumulation, and we can see that we have a giant W formation over the course of 2 days. So in terms of the smart money liquidation process, we can see that smart money move prices through a prior manipulation zone, and this will induce sellers into the market. And again, those retail traders who have seen 3 levels of fall and have chose to stay away from the market will usually begin to start selling now. Okay, so as this selling pressure comes in, smart money buy into the pressure, and we begin liquidating the majority of the position, and we see this small rally to the upside. Now, just like with the M formation, there will be the opposing view of the retail traders, and we will have many buyers begin to buy into the market. So those traders who buy in at the top end or within the mid of the small rally will become trapped as smart money begins the second leg of the W formation and stop those traders out. So if we have buy orders coming into the market in the form of these retail orders during the small uptrend, then their stop losses for these orders are again going to be sells. Okay, so with the M formation, we know that it's the manipulation and the creation of buy orders, and with the W formation, it's the manipulation and the creation of sell orders. So we've already seen an influx of sell orders coming at around this level, and as the second or the rally to the upside begins, we see a new influx of sell orders in the form of stop losses coming to the market, and smart money see this build up of retail sell orders, and they move the market back down, and then they buy into this pressure, and then we see the unfolding of the uptrend. Okay, so no different to the M formation. We're simply seeing sellers come into the market on the breakout of a manipulation zone. Smart money liquidate the majority of their position, causing a trend to the upside. We get buyers come into the market and place sell stops during the mid and also the end of the range. Smart money again see this build up, and with the second leg they move down, hit the stops of these buy orders, and then move the market to the upside. Okay, so you've now learnt that M and W formations are structures that are used by smart money for trapping volume and hitting stops and pending orders of retail traders on both sides of the market. Breakout traders will very often put their stops in the middle and top of the range. Depending on the available volume, smart money will form the shorter or higher M or W structure. Now, in our examples, we looked at the shorter of the two structures. As before, I mentioned that there are two variations to both the M and the W formation, and the variation takes place within the second leg of the structure. So if a substantial amount of retail orders begin to accumulate above or below the recent high or low, smart money will test and penetrate the level with the second level of the structure to induce and absorb more orders. So in the examples that we looked at, we saw both with the W and the M formation that the second leg of the structure was a test and rejection of the most recent high or low. Now, the primary reason for this is that smart money don't want to release the traders who have been trapped at the newly set high or low. So in the M formation, those traders who saw three levels of rise and then decided to buy in at the worst possible time, combined with the traders who bought on the break of the prior manipulation level, many of these guys will be stopped out as the liquidation begins, but those with larger stops will remain trapped. And if smart money were to retest the level, it would allow these traders to either break even or book a small profit. Now, smart money are not in the game of allowing retail traders to book profit, so they head back to the level, whether it be the high or the low, and this allows them to stop out or shake out those traders who are in line with the smart money trend, but not enough to release those traders who have already been trapped. But in times where enough volume does build up above the recently set high or low, then smart money will allow these traders to be released, and they will induce further traders into the market and also absorb any stops that are sat in and around this level. So this is where we will see the second variation on the M and W formation, where the second leg will take out the high in the case of an M formation and the low in the case of a W. Okay, in this example we're looking at the dollar CAD on the 60-minute chart, where we have an M formation which has formed over the course of 4 days. Now, we have the initial high, which was set at the first leg of the M, which was used to induce traders into the market and also liquidate the majority of the smart money position. So as the market begins to fall, as they liquidate their position, and we get those sellers who come into the market, generally what happens is we see that most of their stops are placed above the most recent high. Now, because of this fact, and the sellers are hoarding their buy orders above the most recent high, smart money will see this accumulation of retail orders and they will push the market up with the second leg beyond the most recent high, and this again will induce breakout traders into the market and also hit the stops of those sellers who have sold into the market. So the shakeout process in the M formation variation is slightly different, because smart money are willing to release the trap traders who got into the market on the first leg. They're willing to break the prior high. This in turn induces further buying into the market from those breakout traders, and then the orders of the sellers during the liquidation period will be hit, allowing smart money to absorb more orders at better prices and then ultimately push the market to the downside. Okay, so in the variation, which is very common in all markets and all time frames, we're simply seeing the second leg of the M or W formation take out the most recently set high or low. In this next example on the sterling against the dollar, again we're looking at the 60-minute chart, and we see the same process take place. So we've seen 3 levels of fall to the downside, and then we see smart money penetrate a prior manipulation level. This induces retail traders into the market, those who are late to the trend and also breakout traders. We then see the initial pullback as they begin to liquidate their position. This liquidation will bring buyers into the market, and their buy orders will have an equal and opposite stop loss, which will be a sell. And as we know, the W formation is designed to manipulate and create sell orders. So as the stop losses of these buyers begin to build up below the most recently set low, smart money will see the build up of these retail orders and will be incentivized to release the trap short sellers, push prices down, and hit the stops of the buy orders, and then ultimately move the market to the upside. Okay, so exact same process as with the M formation. We're simply seeing the second leg of the W formation take out the most recent swing low, and this allows them to absorb prices or orders at better prices and ultimately move the trend in their intended direction. And finally, again on the sterling against the dollar, we have an intraday example where out of the Asian accumulation process, we see the manipulation of the Asian lows, inducing retail traders into the market. We then get that pullback to the upside, which induces buyers who are in line with the smart money trend. These buyers will hoard their stops below the most recent set swing low, and smart money will again see this and come down, hit the stops, buy into this selling pressure, and then ultimately move the trend to the upside. And we can see here a significant trend takes place. So the M and W formation and their variations, as we've seen, can take place on both the intraday and also the weekly charts. And as you will learn later, when we have recognized and interpret manipulation taking place at a identified area, we will look to place our stop some ways above or below the most recent swing high or low. And this is because if the variation takes place and smart money decide to test and penetrate the prior level, we will be covered and not be manipulated out of the market. Now, before we move on to our next section, there is one more variation of the M and W formation that I'll quickly like to cover, and this is what retail traders generally refer to and are taught is called the head and shoulders pattern. Now, if more volume begins to accumulate after the second leg of the M or W formation has formed, a third retest of the high or lows can be made. Okay, so we've seen the test and rejection of the second leg of the M and W formation. We've then seen the test and the penetration of the high and low. And with this third variation, this will be a completely new leg that will take place once the second has formed. And the reason for this is exactly the same as the first, and that is if further accumulation of retail orders build up, and it is within smart money's best interest to push prices to those levels to either execute trades or accumulate more orders, then they're going to form this new leg. And again, this is typically taught to retail traders as the head and shoulders pattern, and the identification and also the trading of the pattern is very popular and very well known. But again, just like with the markets and everything else we've learnt throughout this course, is generally misunderstood as to the process which is taking place. So in this example, we're looking at the Australian dollar versus the New Zealand dollar, and we've had 3 levels of rise to the upside, and then we can see that we have an initial M formation, and then we have a third test of the highs. Now, the process behind why this happens is exactly the same. As we know, where we have the shakeout of those traders who are in line with the market maker trend, place their stop loss above the highs of the first leg. If there is enough volume, we know smart money will push prices back to stop out those orders, sell into these buy stops, and then push the market to the downside. Now, once this happens, we would generally see the beginning of the new trend unfold. So we've had sellers enter the market, place their stop above the most recent high, and then smart money come up and they hit these buy stops, and then as they sell into these buy stops and the market begins to move back down to unfold the new trend, we get more sellers coming to the market who again are in line with the smart money trend. These new traders place their stop above the most recent swing high, and the orders build up so much that smart money are incentivized to push prices back up and sell into these buy stops before ultimately unfolding the trend to the downside. So the same process is taking place. We're just simply seeing it happen twice. So above these levels, we're seeing the stops of the retail traders who are coming into the market, and each time we see a break of the highs, we're also getting the buy orders of those breakout traders. So as the orders build, smart money will be incentivized to go up into these regions to execute and absorb their orders. And if the orders stack there and it's within smart money's best interest, I mean, they will go up there 5, even 6 times if they have to. But the head and shoulders pattern, as this is commonly referred to, is widely known, and it's something that you will see on all markets and all time frames. And this is again why it's very important that once we have seen a stop run of a level, that we're able to get in very close to the highs or lows and allow us to place our stop some ways away from the most recent level. But this is something again you're going to learn later on in the course, but for now, just be aware that the testing and the taking out of a level can occur more than once. Okay, so before we move on to our next section, just a quick point and a guideline to help you when working with M&W formations. Now, I don't recommend indicators. I very rarely use them myself, but when it comes to the interpretation and combining an indicator with the smart money trend and also the candlestick and the formations of manipulation that you will learn later on in this course, then divergence can become a very powerful tool in identifying potential reversals. So when you're looking at a M or a W structure and you have the second leg with a divergence to the first, this can be a very powerful indication that a reversal is underway. And the same is true when looking at the third or even the fourth pass at a high or low. So in our previous example, when we saw 3 swipes to the high, if we see divergence take place in the second and third legs, we can be quite confident, combined with everything else, that a reversal is about to take place. But again, I do stress that the indicators should be used in combination with the smart money trend, the weekly cycle, and also the candlestick formations and the techniques that you're going to learn later on in this course.